Okay, let's unpack this. You ever feel like you're navigating a financial wilderness and there's a hungry bear, a financial bear lurking just out of sight, ready to shred your portfolio?
Yeah, it's a daunting prospect, absolutely.
But what if we could learn something from those who faced this beast before and actually seen it retreat? That's kind of what we're doing today.
Well, what's fascinating here is the idea that history, even, financial history, doesn't always repeat itself perfectly, but it often rhymes,
Yeah.
as they say.
Right.
And by looking at these past moments where the market really hit rock bottom, we might just find some clues, some patterns maybe,
Yeah.
to help us understand, well, what's happening now or what might happen.
Exactly. And for this deep dive, you shared a really insightful piece, Anatomy of the Bear, Lessons from Wall Street's Four Great Bottoms.
Hmm.
It's a study that really rolls up its sleeves and gets into the nitty-gritty of four major bear market bottoms. We're talking August 1921, July 1932, June 1949, and August 1982.
Think of it like a forensic analysis almost of these key market turning points.
Right. Yeah, forensic is a good word for it.
And if we connect this to the bigger picture, I mean, understanding the economic conditions back then, the structure of the market, which was very different, and even the investor sentiment around these bottoms, it gives us a much richer, more nuanced perspective than just looking at charts alone.
And that's really our mission today, isn't it? We want to pull out the key insights, the recurring patterns, maybe those aha moments from these historical events.
Yeah, find the threads.
The goal here is really to give you, the listener, a bit of a shortcut to understanding some really complex market dynamics, provide some valuable historical context, and hopefully help you feel a little less maybe overwhelmed by all the financial news flying around.
Okay, so where do we start? Which bottom first?
Let's start at the beginning, right? August 1921.
Okay, 1921. That's a particularly interesting starting point. The road to that bottom was really paved with the aftermath of World War I.
Right, huge global shift.
Exactly. You had this significant inflationary period. And in response, the Federal Reserve started tightening monetary policy. They were essentially raising interest rates, making borrowing more expensive. Put them brakes on. Pretty hard. And that put a considerable squeeze on the economy and the markets, which, led into the bear market. And it's worth remembering, too, this period also saw events like the Wall Street bombing in September 1920.
Wow, yeah.
Which really just underscored the sense of uncertainty that was around at the time.
Right, paints a picture of a world really grappling with big shifts. Now, what did the market itself look like back then? Like, who were the major players?
Well, the structure of the market in 21 was quite different from what you see today. The study highlights key sectors like rails, industrials, utilities, mining, retail, tobacco.
The old economy, sort of?
Very much so.
Yeah.
But interestingly, there were also emerging sectors with names that are still incredibly familiar. Think American Express, AT&T, Coca-Cola, GE.
Wow, they were around even then.
Oh, yeah. But a notable difference was the absence of major financial institutions listed on the New York Stock Exchange back then.
Huh. That is different. And you mentioned the Fed tightening. How did liquidity, the flow of money, play into this?
Oh, this is crucial. The Fed's elastic currency, which was initially designed to prevent financial collapses and, used heavily to finance World War I,
Right.
it was then contracted. And the debate within the Fed at the time, it was quite intense, actually. They were arguing about the desired level of deflation.
Deflation, not inflation.
Deflation, yeah. And what's really striking is that they actually postponed interest rate cuts until they saw reductions in wage rates.
Seriously. They waited for wages to fall.
They did. They deemed it necessary.
Yeah.
So the Fed wasn't just looking at its own balance sheet as the primary guide. They were actively trying to manage the price level in the broader economy, including wages.
That's a very different approach. So, okay, if you were an investor trying to read the tea leaves back then, what were some signs that the market might be bottoming?
Well, the study points to price stability as a really important signal. That seems to be a key thing.
Okay.
For instance, the Frankfurter Zeitung stock average, a German index, interestingly saw a significant rise. Domestically, you saw a stabilization of commodity prices.
Ah, commodities again.
Yes. And interestingly, commercial banks started increasing their buying of government bonds simply because there was low demand for credit elsewhere.
Okay, so money had to go somewhere safe.
Exactly. These were subtle shifts, perhaps, but they suggested that the intense deflationary pressures might be easing off. So you're already seeing this potential pattern emerge. Stability in prices seems to be an early whisper, maybe, that the storm might be passing.
Investor sentiment is always such a key piece of the puzzle, isn't it? What were people feeling and doing around that August 1921 bottom?
Yeah, and this is where it gets really interesting. Because contrary to what you might expect, right, the usual story.
Total despair, everyone's selling.
Exactly. But there wasn't widespread, overwhelming pessimism at the absolute bottom. Now, there were accusations of bear raids, manipulation,
Yeah.
and you saw the emergence of what were called constructive interests, essentially big players, smart money perhaps, stepping in to buy.
Ah, okay.
And the success of the American telephone stock offering during this period is also pretty notable. It shows pockets of confidence, or at least willingness to invest.
That is counterintuitive. Why do you think that usual narrative of just complete despair at the bottom doesn't seem to hold true here?
Well, that raises a really important question, doesn't it? It suggests that maybe the absence of that extreme, final, panicked selling can itself be a sign.
Hmm.
Maybe it means that most people who wanted to sell or had to sell have already done so. The selling pressure just kind of peters out, even without widespread optimism immediately rushing back in.
Interesting. Okay. And what happened after the bottom? What did the recovery look like?
Well, the post-bottom period ushered in the Roaring Twenties, a very strong bull market,
Right. The same as boom.
fueled by things like the electrification of America, huge productivity gains, low inflation. It's a really stark contrast when you look ahead to the Fed's response in the early 1930s, where they were much, much more hesitant to act during the initial stages of the Depression.
Which, of course, leads us directly to our next bear market bottom in the study, July 1932. Right in the absolute depths of the Great Depression. What was the backdrop this time?
Yeah, grim is probably an understatement. The road to July 1932 was obviously dominated by the devastating stock market crash of 1929 and the ensuing economic collapse.
Unprecedented.
Absolutely. But interestingly, despite the severity of the downturn, the number of stocks listed on the NYSE actually increased significantly between 29 and 32.
Really? That's surprising.
It is. And there was also a shift in market leadership. Railroads started losing their dominance to utilities, oil, and communications companies. The structure was evolving even then.
The bond market often gets overlooked, especially when we talk about stock market crashes. What was happening with bonds leading up to the 32 bottom?
That's a crucial point, and it reinforces what we saw in 21. Bond prices didn't fall nearly as dramatically as stocks. Their turnover was also lower.
More stable, relatively speaking.
Yes. And interestingly, the study notes the lowest May bond turnover on the NYSE since 1918 occurred just before the bond market started to rally in 32.
Okay, so activity dried up right before the turn.
It suggests maybe a period of, I don't know, exhaustion, or perhaps just less panic in the bond market compared to equities. It's fascinating, this idea that the bond market, often seen as the quieter cousin, seems to send these potentially crucial early signals.
So even amidst all the just unbelievable gloom of the Depression, were there any glimmers of good news that might have signaled a turning point brewing?
Well, the prevailing sentiment was definitely one of deep, deep pessimism. The study mentions Charlie Chaplin's quote about feeling he was as much an economist as financiers were comedians.
Ah, that captures it.
It really does. But the study does point to some early, maybe tentative signs of improving business activity in places like Chicago and Detroit. July 32 saw the first noticeable expansion in industrial activity for the entire year.
The first sign of life.
Yeah, and commodity prices started to increase a bit, which led to some inventory replenishment. Very early signals, very fragile, but they were there.
So we see that pattern of commodity price stabilization possibly emerging again, even in that environment.
It seems so, yes.
And what about investor behavior? Any changes in trading patterns or sentiment at that absolute low point?
Trading volumes were extremely low,
Mm.
just incredibly low. And a striking fact, over 50% of the stocks being traded were priced under $10 a share.
Penny stocks, essentially.
Almost, yeah. Shows the devastation. Interestingly, though, the Dow theory, which looks at the relationship between the industrial and railroad averages, actually indicated potential support in the railroad sector, even as the industrial average was hitting new lows.
So different indicators giving conflicting signals again. Fascinating. The study also touches on fiscal policy. What was the government's thinking?
Surprisingly, both President Hoover and the candidate Roosevelt were focused on achieving a balanced budget.
Even then, in the middle of the Depression.
Yes, there was a real deep-seated fear of even a small deficit, which of course we know now seems incredible because the deficit actually increased massively during the subsequent bull market.
Right. Hindsight makes that initial focus seem almost, well, ironic.
It really stands out as a unique characteristic of that particular bottom, that fiscal mindset.
And did the bond market play that signaling role again, like in 1921? Did it bottom first?
Yes, it did. Corporate bonds actually bottomed out before equities in 1932.
Mm-hmm.
And significantly, this was linked to that stabilization of commodity prices we just talked about,
Okay, so there's a connection there. Stability in the real economy
reflected in commodity prices.
seems to influence the credit markets.
And then subsequently equities. It reinforces that potential chain of events.
And the recovery from this incredibly dark period, what did the post-bottom era look like?
Well, you saw a significant bull market from 1932 to 1937, actually, which is remarkable given the ongoing concerns about, what many on Wall Street were calling socialism with the New Deal policies.
Right, huge policy changes happening.
Massive changes. The recovery did kind of stutter temporarily, partly due to uncertainty around FDR's policies, particularly regarding the gold standard. And you had the Pecora hearings exposing a lot of Wall Street misdeeds.
It must have shaken confidence.
Oh, absolutely. Led to more regulation, a more cautious environment, perhaps. Then you get another significant market downturn in 1937-38, maybe linked to Fed tightening again, maybe changes in fiscal policy, and of course, the growing shadow of war in Europe started to loom larger and larger in the financial outlook.
So from deep depression to the looming threat of war, the market landscape just constantly shifting. Okay, let's move forward in time again to our third historical bottom. June 1949, post-World War II. A different set of challenges, different anxieties, I assume?
Definitely. The post-World War II period initially saw a really strong economic boom, but then fears of post-war deflation started to emerge.
Deflation again, like after WWI?
Exactly. It was a concern that echoed the periods after World War I and even way back after the Civil War. Plus, rise in wages started to squeeze corporate profit margins, and the end of wartime price controls added to the uncertainty. Even President Truman warned of potential bad times ahead.
So a sense of unease despite the recent victory. How had the market structure evolved by 49 compared to, say, 1932?
By 1949, the total market capitalization of NYSE stocks had increased quite a bit compared to 32, although it was actually still below the peak of 1929.
Still hadn't fully recovered from the crash, market cap-wise.
Not quite. And interestingly, the investment management industry was still relatively small at this time. The study mentioned only about 150 registered investment management companies with the SEC.
Wow, tiny compared to today.
Tiny. And their total funds under management were just a fraction of the overall market, much more dominated by individual investors still.
Despite these anxieties and the deflation fears, were there any signs of resilience or improving conditions that might have, foreshadowed the bottom?
Yes, definitely. The study highlights several reports of improving business conditions in various sectors, like rayon and textiles. Retail sales actually held up surprisingly well, even with rising unemployment.
How did that happen?
Attributed mainly to inventory reduction, businesses were selling off stock. Plus, the automobile and building construction industries remained quite active. Lots of pent-up demand from the war years.
Makes sense.
And even though industrial power consumption saw its first year-over-year decline since 1946, which sounds bad, residential and commercial power sales growth remained strong, and the brass industry reported a pickup in sales. So again, you see these pockets of underlying strength, even during a downturn. The economy wasn't just falling off a cliff.
Okay. And what was the mood like on Wall Street around this time? What were investors and the brokerage firms saying?
Well, brokerage firm commentary started to suggest that stocks were actually offering pretty attractive values. There was this growing anticipation of improving market psychology.
What was driving that hope?
Fueled by factors like, no war, no major tax increase expected, no big anti-labor legislation, and importantly, cheap money, low interest rates.
Okay.
And the study points to things like the high average age of cars in use, indicating significant pent-up consumer demand ready to be unleashed. Even the boom in Las Vegas, believe it or not.
Vegas.
Yeah, was seen by some as a quirky sign of returning consumer confidence in, discretionary or even luxury spending.
Huh. It's funny how you can find indicators anywhere if you look hard enough.
Sometimes the seemingly unrelated things reflect the broader mood, yeah.
You mentioned the importance of price stability in the earlier bottoms. Was that a factor again in 1949?
Absolutely. It's becoming a very consistent theme, isn't it?
It really is.
Just like in 21 and 32, the reemergence of demand at lower prices for various commodities was seen as a key indicator that deflation was ending. You saw rises in the prices of rents, food, wheat, oil. And importantly, inventories were low.
So real demand, not just restocking.
It suggested that the price increases were driven by genuine demand, not just speculation or businesses rebuilding inventories. So yes, the theme of commodity price stabilization as a key signal definitely continues to hold.
And how did the Federal Reserve's actions or maybe anticipated actions play into this?
Well, the Fed had started to shift towards an easier monetary policy. They stopped intervening to prevent government bond prices from rising.
Which means they were okay with rates going down.
Exactly. It signaled a preference for lower interest rates, even if it took a little while for that to fully translate into, say, an increase in Fed credit outstanding.
Yeah.
These policy signals were arguably more important than just analyzing the Fed's balance sheet numbers week by week.
So the direction of policy mattered more than the immediate data.
In this case, it seems so. And it's striking again to see the evolution of the Fed's approach over these decades, right? From trying to manage wage levels in the 20s to later focusing more on broader money supply targets, and here, signaling through bond market operations.
We've talked about the Dow theory a couple of times. Did it offer any clues in 1949?
Yes, it did. The Dow theory, for those who follow it, apparently provided another successful signal right at the bottom in 49.
How so?
The intraday lows of both the industrial and the railroad averages were not breached during a key test. That was a critical indication for followers of the theory. And the study mentions prominent figures like E. George Schaefer, who were writing bullish newsletters for their clients based on these Dow theory observations.
So some technical signals were flashing green, or at least not red. Finally, what about investor participation? Were the big boys coming back, or was it still mostly small investors?
General interest in stocks seemed to remain relatively low throughout that bear market, actually. But widespread ownership among small shareholders was still very evident.
Like the AT&T example.
Exactly. The AT&T stockholder vote saw record participation, but a huge percentage of those shareholders held tiny amounts of stock. The bulls, the market observers, were apparently waiting for signs that big constructive interests, those larger, perhaps institutional players, were starting to consolidate holdings.
Suggesting a shift maybe from widespread retail fear or apathy to more concentrated, informed buying.
That seemed to be the anticipation, yeah. A sign that maybe a new phase was beginning.
Which leads us finally to our last historical bear market bottom in the study, August 1982. Now, this one feels much more recent, perhaps more familiar territory for many of us. What was the economic climate leading up to that bottom?
Yeah, 1982. The road there was really characterized by the hangover from the 1970s, a weak dollar, a really struggling bond market, and a pretty lackluster equity market for much of that decade. Stagflation was the big story.
Right, high inflation, low growth.
Exactly. And interestingly, this study notes the sequence. The dollar actually bottomed first, then bonds started to turn, and only then did equities finally hit their lows.
So a potential sequence there, too. Currency, then bonds, then stocks.
Potentially, yeah. And the sectoral landscape had continued to evolve, too. The decline of traditional heavy industries like railroads was even more pronounced, and the rise of finance and service-oriented businesses was really taking hold.
Were there any pieces of good news starting to emerge amidst that challenging environment of high inflation and recession?
There were a few things. The Commerce Department's leading economic indicators actually started to rise, suggesting, maybe a recovery was on the horizon. Alan Greenspan, who was advising President Reagan at the time.
Before his Fed chairman days.
Right, exactly. He apparently predicted that signs of recovery would appear within weeks. And maybe more counterintuitively, Robert Wilson, a prominent investor and known more for his short selling.
A bear, usually.
Often, yes. He took a rather intriguing bullish stance. He was betting on an economic recovery despite the super high interest rates, partly because so many people thought it couldn't happen. A contrarian play.
Interesting. We know inflation was the huge story of the late 70s and early 80s. How did price stability, or the lack thereof, play into the 1982 bottom? This seems different from the deflationary bottoms.
It was a very different inflationary environment, that's true. Inflation, as measured by the CPI, was actually falling quite sharply from very high levels during the 81-82 recession. So you didn't have deflation in the CPI sense, maybe just briefly.
Disinflation, then.
Disinflation, exactly. But if you looked at commodity prices, the decline was much more significant. The CRB index, a broad measure of commodities, fell by over 30% from its 1980 high to its 1982 low.
Ah, so commodities did fall hard.
They did. And the stabilization of commodity prices, following that sharp decline, seemed to mirror the patterns seen in the previous bear market bottoms we discussed. even though the overall context was inflation, not deflation.
So the pattern of commodity price behavior, big drop, then stability might be more important than the absolute level or whether it's inflation versus deflation.
That seems to be what the study suggests, yes. The stabilization still appeared as a significant signal, even in that transitioning high inflation environment.
Fascinating. Okay, liquidity and the Fed's actions were critical earlier. What was happening on that front in 82? Volcker was Fed chair, right? Famous inflation fighter.
That's right, Paul Volcker. The growth rate in non-borrowed reserves, a measure of liquidity the Fed provides, did start to increase. But it was apparently quite difficult for investors to interpret this in real time because the money supply data itself was incredibly volatile.
Noise in the
A
data.
lot of noise. And there was a huge debate among commentators about whether the Fed was genuinely easing policy or if it was just temporary fluctuations. Interestingly, despite major concerns about the growing budget deficit under Reagan.
Which people thought would keep rates high.
Exactly. Volcker himself suggested that the deficit wouldn't necessarily prevent interest rates from falling further. Bit of surprise, maybe.
The early 80s also saw that significant international banking crisis brewing, didn't it? Mexico, Poland.
Yes, the LDC debt crisis, less developed countries. It created a lot of additional uncertainty and fear in the financial system.
Worries about bank failures.
Absolutely. There were real concerns about the stability of major international banks that had significant exposure to these troubled sovereign loans. Added another layer of fear right near the bottom.
So with all these cross currents falling, inflation but high rates, fiscal deficits, international crisis, what ultimately seemed to trigger the bottom and the big rally that followed?
A key catalyst appears to have been the Fed's aggressive easing of monetary policy after they effectively abandoned their strict money supply targets.
Volcker blinked, or shifted strategy.
More like shifted strategy once inflation showed clear signs of breaking. They significantly reduced the discount rate multiple times in rapid succession, and the bond market reacted very strongly and positively to this news. It rallied hard.
Bond market leads again.
Seems so.
Yeah.
And the equity market actually bottomed right around the time the full scale of that international debt crisis was becoming apparent. The market started rallying, even despite some of that bad news hitting the headlines.
Suggesting the Fed's positive action was maybe outweighing the bad news?
It strongly suggests that a decisive, positive Fed response was a crucial factor in finally turning sentiment around, even in the face of ongoing problems.
And what about investor sentiment at that specific point? Did we finally see the classic signs of capitulation, that big washout?
You know, interestingly, the 1982 bottom, just like the other three major bottoms the study looked at, was marked by the absence of a final high-volume, panic-driven sell-off in stock prices.
No big puke.
Not really, no. Which apparently confused some investors and commentators at the time. They were waiting for that classic final washout, and it didn't really happen in that textbook way.
So they doubted the rally at first.
Yes, the study mentioned skepticism from well-known commentators because they hadn't seen that capitulation event they expected. It really reinforces that earlier observation we made, maybe that final dramatic capitulation isn't actually mandatory for a major bottom.
Wow. Okay, one last piece on 82. The bond market played a big role, and the study mentions Henry Kaufman, a very influential bond market guru back then, making a huge bullish call right around the bottom. What was his reasoning?
Yeah, Kaufman, Dr. Doom, as he was often called, made this surprising bullish call on bonds. It seemed counterintuitive given the deficits and recent history. His reasoning apparently was based on the expectation of further economic deterioration, which he thought would force rates down, combined with a flight to safety due to all those concerns about the financial system and the international debt crisis.
So bad news is good news for bonds.
In his view at that moment, yes. And his change of opinion was incredibly influential. It really spurred a significant rally in the bond market. And his forecasts for much lower rates ultimately proved correct, surprising many who thought long-term rates just couldn't decline so much with those fiscal challenges.
Okay, so we've walked through 4 really distinct historical episodes, looking across all of them, 1921, 1932, 1949, 1982. What are some of the cross-cutting themes, the key takeaways that really stand out from this study?
Well, several important patterns do seem to emerge, despite the very different eras. Firstly, price stability, particularly the stabilization and then often the rise of commodity prices. That appears to be a pretty consistent early indicator that deflationary pressures are ending, or in the 82 case, that disinflationary forces are strong enough.
Okay, commodity prices. What else?
Secondly, the bond market lead. We saw repeatedly that a recovery in government bond prices or even corporate bonds in 32 has historically preceded the equity market recovery. The time lag varies, but the sequence seems common.
Bonds first, then stocks. Got it.
And thirdly, and this was perhaps the most surprising, the absence of that final high-volume capitulation sell-off at the bottom of these major bear markets. It really challenges the conventional wisdom about what a market bottom has to look like.
Right, that idea you need everyone to throw in the towel in a panic. Maybe not always. And the role of the Federal Reserve, it seems to have evolved quite a bit over these periods, hasn't it?
Oh, massively. The Fed's role has definitely shifted. You see this transition from an environment heavily constrained by the gold standard in the earlier periods to a much more discretionary approach to monetary policy later on, aimed at managing both inflation and economic activity. The study really highlights how the Fed's focus, its tools, and maybe even its understanding of its impact have changed significantly over time.
Investor psychology is always that wild card, isn't it? Any consistent patterns there across these bottoms?
Well, you definitely see a mix of fear, skepticism, and then eventually a gradual return of confidence around these turning points. But what's interesting, as we noted, is that the absolute deepest pessimism doesn't always seem to coincide precisely with the absolute price bottom.
It might come a bit before or linger after.
Exactly. There often seems to be this period of quiet resignation, maybe exhaustion, before the market actually starts its sustainable recovery. Not necessarily panic, just apathy or disbelief.
And the structure of the market itself, did the study point to any recurring trends in terms of which sectors lead or lag out of a bottom?
Less of a consistent pattern in there, actually. What's more striking is how dramatically the dominant sectors of the stock market have changed over time. It reflects these broader economic and technological shifts. Railroads were key early on, then utilities gained prominence, and later you see finance and technology becoming much more important. It's a constant reminder that the market is a dynamic, evolving entity.
Okay, so if we try to distill it all down, is there a single magic indicator? A foolproof signal that tells us, okay, this is the bottom.
Huh. If only. No, the study makes it pretty clear that there's no foolproof single indicator. While these patterns we've discussed, commodity prices, bonds, sentiment do recur, it seems a more holistic view is essential. You need to consider price stability, bond market behavior, investor sentiment, and the actions and signals from the Federal Reserve all together.
Right, it's about the confluence of factors, not just one thing. So as we wrap up this deep dive into the anatomy of these past bear market bottoms, what are maybe the one or two most important lessons for us to remember today when we look at current markets?
I think the consistent importance of stabilizing commodity prices
Right.
as that signal that deflationary or strong disinflationary pressures are easing, that's a really key takeaway. Also, that tendency for the bond market to often lead equity market recoveries, it's a historical pattern worth paying attention to. And finally, maybe just remembering the surprising absence of that mandatory textbook capitulation sell-off at these major bottoms. It reminds us to be wary of relying too heavily on conventional wisdom or waiting for that one dramatic event that might not actually happen the way we expect.
That's a great point. Don't get fixated on one narrative. And how might these historical patterns be relevant, you think, to the market conditions you and I are observing today, without making predictions, of course?
Well, if we connect it back to the source materials conclusion, it emphasizes the role of a material disturbance to the general price level, basically. Big shifts in inflation or deflation in creating the uncertainty that drives equities down to cheap levels. So looking at these historical examples, those disturbances involved periods of high inflation followed by deflation, or in 1932, just severe deflation itself. Given our current institutional framework, our current economy, it prompts us, to consider what kind of future inflationary or perhaps even deflationary pressures might emerge, and how those might act as that disturbance that the study talks about, potentially creating opportunities down the line.
Fascinating way to frame it. Looking for the source of the next major price level disturbance. Okay, so as we let all these historical lessons sink in, here's maybe a final thought for you, the listener, to chew on. Considering these historical episodes, what do you think might be the unexpected signal that indicates a significant shift in the current market trend?
Hmm.
It's not always the loudest headlines, is it? As we've seen, it might just be a quiet shift in commodity prices or the bond market, or maybe sentiment just getting exhausted rather than panicked. A subtle change in a corner of the market that actually has a lot more to say than we might realize at first glance.